When it comes to trading volatility events, there are two different categories to consider: short-term pullbacks and recessions. Most of the time the economy is growing, and most of the time the stock market is going up. But when a recession hits, stock prices plunge. Even just the hint or increased risk of a recession is enough to drive down stock prices, even if an actual recession never materializes. Recessions are fairly rare, but they last for a long time, anywhere from 6 months to a year and a half. The last recession was the Great Recession from December 2007 to June of 2009. Before that, we had a recession in 2001 from March to November. I'm not going to read through all of the characteristics of each of the most recent recessions, but feel free to pause this video and spend some time digesting these events if you feel inclined to do so. I'll add a link to the additional materials below, so feel free to check that out as well. If we bring up a long-term chart of the S&P 500 ETF, the SPY, we can see how it was impacted by some of the big events of the last several decades. Here's the Great Recession highlighted in red, and here's the dot-com recession of 2001. You can see that both of these were accompanied by prolonged bear markets. So when we're talking about a recessionary volatility event, usually that's what we're dealing with, a bear market. Pullbacks, on the other hand, are much more short-term in nature. Here's the pullback that occurred during the Ebola scare. You can see it was over in a month. It had no impact on earnings or GDP growth, but it was a great short-term trading opportunity. That's what pullbacks are: short-term drops in a longer-term uptrend. These are great opportunities for volatility trades. Recessionary events make great trades as well, but you need to approach them a little differently, with a little more patience and caution. Let's look at the S&P 500 over just the last year now, and let's compare it to the VXX, which you can see had a ridiculous amount of decay in just the last 12 months. Let's look at the tradable volatility events. Here we have the election, where the market at first was worried about the possibility of a Trump election, but then when he was actually elected, it rallied like crazy. It's pretty amazing how often this pattern plays out. The market panics about something until the event actually happens, then it rallies as if it didn't matter at all in the first place. In September, there was a Fed scare where the market was worried about a Fed rate hike. Then when the Fed did nothing, the market recovered. In June, there was Brexit, when the UK voted to leave the European Union, and in the first few days the market was swamped with horror stories and people panicked, but when the market remembered that Brexit doesn't affect earnings in any way, especially here in the US, the market rallied back again. All three of these are good examples of pullbacks, or volatility trades from short-term events that really have no recession risk. But in January we had a different event. Here, the price of oil was plunging, and there was a fear that it could lead to the collapse of some major oil companies, which would add massive losses to the banks, which had loaned them money. In addition to that, there was a fear that a recession was imminent, and the odds of a recession were higher than usual, but an actual recession never materialized. This was a more dangerous event than a normal pullback, and I'll show you one of the warning signs that you can use in your own trading to help tell the difference between a short-term pullback and what might be the start of a longer-term bear market. Overall, with all four of these trading events, I made about an 80% total return from this strategy. Hopefully now you can see why it's so useful to have this strategy in your arsenal. Even if you've got other trading systems like I do, or you own a portfolio of stocks, this strategy is a great way to add extra income to your account. It's such a low-risk, high-probability trade that it's great even if you only get 1 or 2 trading opportunities per year. Here's the VIX since 1990, with each bar representing 1 month of time. Before 1990, it wasn't a calculated and measured value. Remember that you can't invest directly in the VIX itself, it's just a calculated value. What you notice immediately from looking at this chart is that nearly all of the VIX spikes are really short-term in nature. Most of them are only about a month, with a few lasting a few months. The exception is the 2008 crisis, where the volatility spike lasted about 8 months. This is the risk you face in every trade. The risk is that what starts as a volatility spike could turn into a full-blown recession and financial crisis. 2008 was worse than any recession since the Great Depression because the entire global banking system was at risk of collapse. Most people will say that this was caused by the drop in housing values, and this is true, but the bigger problem was just that the banks were using way too much leverage. The good news, though, is that today the banking system is much, much safer and far less levered. And personally, I doubt we'll see another 2008 style crisis again in our lifetimes, but the risk is always there that something unpredictable can happen at any time. So how do you deal with this risk? What happens if you short volatility and it keeps going higher? Well, your first line of defense is your decision when to put on the trade. When you're dealing with a recessionary event or a major crisis, you should wait for a higher level of volatility before you put the trade on. So how do you know if you're dealing with a pullback or a recessionary event? First of all, let's summarize. Most of your trades are going to be pullback events, where you enter the trade quickly before the opportunity disappears, and usually you'll get a fast recovery and be out of the trade in a month or less. In a recessionary event, there's no need to rush into any volatility trades, since these types of events can drag on for a while, and you'll usually get a better entry point by waiting until every investor has had plenty of time to panic and dump their stocks. So you'll want to wait for a higher VIX level than you would for a pullback, and also expect a longer recovery time. You can get a feel for the type of event you're dealing with by simply reading the news or watching CNBC, but I like to share a great leading indicator with you right now that you can use to get an idea for where the market is headed. Chart-based indicators are not always right, but the thing I like about them is they're based on an average of opinions and actions of market participants across the entire market, whereas any analysis you read is usually just the opinion of one guy alone. Here's the advanced decline line for the last 2 years. It's calculated by taking the number of advancing stocks minus the number of declining stocks per day, and this chart is for the New York Stock Exchange. A leading indicator means that it tends to act like a canary in a coal mine, giving us a warning before something happens instead of after, which is what we want from an indicator. Here's the S&P 500 over that same time frame. This indicator tells you something important whenever it diverges from the market itself. If it's doing the same thing as the market, it doesn't really tell you anything at all. Let's look at Brexit as an example. Look at how the advanced decline line broke to a new high in April, well before the rest of the market broke out. This was a huge bullish signal. And when I saw the market sell off from the Brexit vote, I knew this was going to be over really fast. And I figured the market would probably follow up by making new highs in the next few months. And sure enough, the Brexit sell-off was wiped out in 1 week. And the market followed the advanced decline line to new highs in the next week. Okay, now let's look at the sell-off in 2015. If we draw a support line from the lows in March, we can see that the advanced decline line broke down in July and August, even though the market was holding up better. If the advanced decline line was making new highs here, it would have been a reason to be bullish, but instead it was breaking down. And this is an ugly warning sign that something bad is lurking. Sure enough, the market had a huge sell-off soon after. The poor performance of the advanced decline line through this whole period, and even into the beginning of 2016, was a warning sign that the market was not healthy and that you needed to proceed with more caution. To summarize, if you notice the advanced decline line underperforming the market, this is a big red flag that you might be facing a recessionary event. The fact that the market was unable to make new highs and then began breaking the lower support levels was another warning sign.